In this video tutorial, we will discuss the differences between buying a home being sold as a short sale, a bank-owned home, and then of course a home being sold as a standard sale. Here's 15 things buyers must know about buying short sales. 1. What is a short sale? A short sale is a transaction in which the market value of the home is below the balance of the loan or loans owed to the lenders by the owner-seller. This means one or more lenders has to approve the transaction. So in reality, a short sale is an agreement between a homeowner, their lender, and a third-party buyer. 2. Are you serious and will you last? Short sales take time. Many buyers can't wait for the short sale approval that seems to take forever, and they walk. To curb this, some lenders who are presented real estate offers from buyers that involve a short sale force the buyer to agree to forfeit the earnest deposit money if they walk or can't meet their obligations within, say, 2 weeks of the short sale approval. 3. What's HAFA and how does it affect things? As of December 2010, new government legislation known as HAFA, short for Home Affordable Foreclosure Alternatives, introduced streamlined, less harsh rules for homeowners who wanted to short sell their home. This means short sale transactions can close quicker than ever before, as long as the lender or lenders involved in the short sale you are buying follow the HAFA rules. Not all lenders will, and they are not obligated to. 4. The buck stops where? Sellers will usually accept whatever short sale offer seems bona fide because at the end of the day, they're not the ones about to take a loss. The lender or lenders they owe money to are the ultimate decision makers that must agree or disagree with your offer and terms. 5. Possible delays beyond your control. If the seller doesn't cooperate with their own lender or lenders pertaining to necessary items like hardship letters and financial documents, the entire process can be delayed. The lender will likely have a checklist of requirements and paperwork required for the short sale process. And despite the motivation level of the often delinquent homeowner, they have to provide all necessary documents for the short sale approval to be issued. 6. Be prepared for a counteroffer from the seller's lender after they've sent an appraiser or other evaluator to the property to determine fair market value. Lenders may stop at BPO, known as broker price opinion, and yet others will want a full-blown appraisal of their own. If you offered $100,000 on a home that they believe is worth $130,000, your offer will most likely be countered. 7. Multiple offers. Are you prepared? There's a good chance there will be more than one offer on the home. Be prepared to revise and maybe even increase your offer to compete with others. This means through your agent or otherwise, you need to decide before you make an offer how far or how high you're willing to go without ignoring comparable sales in the area. A rule of thumb is to make your first offer your best offer. It can be difficult to discipline yourself in that way, however, so refrain from allowing your emotions to take over. 8. Repairs and costs. Most sellers that are short selling are in financial trouble, so there's a good chance the seller will not be able to do any Section 1 repairs resulting from the wood-destroying pest inspection, for example, termite infestation. This may vary from state to state and lender to lender, but the expense may fall on you. 9. Know your worst competition. Short sales attract investors. Be prepared to bid against all cash offers. These often make it difficult for buyers who are dependent on financing to be successful in purchasing short sale homes. To make your offer stronger, consider putting down a larger earnest deposit or offering to close quicker than normal. 10. Approved short sales. What is an approved short sale? It only means what the real estate agent listing that home for sale meant it to mean. How so? Some agents will list a home and call it an approved short sale just because the lender who has a lien on the home has received the seller's hardship and financial documents and has simply agreed to a short sale. There might have been no mention of price at all. Now, there is no way to know the final number the bank is willing to accept on the house until an offer is presented to them. This can be a really sneaky way of getting traffic to a short sale home. In its truest sense, an approved short sale means at some point the lender or lenders indicated to the seller and realtor what their bottom line price would be on the home. This often happens when another buyer makes an offer on the home and the lender counters that offer. The buyer may walk away, but what the lender would settle for to release their lien on the property has been unveiled, albeit unintentionally. Under Hoffa rules, a home sale price may be approved by the lender before the home is even listed for sale. 11. Lowball offers. Be realistic with your offer. Don't insult the lender or lowball them. According to the National Association of Realtors, close to 80% of the offers made on short sale properties are not accepted. It's true that lenders don't want to foreclose and take back homes which remain on their books with all the upkeep involved. By the same token, lenders need to answer to their investors and aren't going to give away the home either. 12. Surprises at or before closing. Short sales often, not always, involve sellers who are financially in trouble or experiencing some other hardship such as divorce or medical emergency. They often forget stuff or worse, conceal things that are very important. For example, does the seller have an undisclosed second or even third mortgage against the property? Are there mechanics liens or even IRS tax liens against the owner? In a short sale, all liens need to be satisfied or released before you can safely close. If you are getting a mortgage loan, then your lender will require title insurance, and this should solve the problem. But cash buyers, beware. Don't close without doing a public record and title search. Do your due diligence. Better you wasted a few $100 on appraisal fees, home inspection, and so on than end up with a house that has a few $100,000 of other obligations against it. 13. Rejects. Not all short sales are approved. Sellers may not be eligible for a variety of reasons, including mortgage fraud, or they may make too much money to be considered to have a financial hardship. Regardless, as a buyer, you need to know that after weeks of waiting and negotiations between the owner, seller, and their lender, a short sale transaction could technically fall apart. 14. Death by mortgage insurance. Many a short sale transaction can die because, often overlooked by unsuspecting real estate agents or the owner, the loan in question, for which all parties are hoping to secure a short payoff, carries private mortgage insurance, otherwise known as PMI. The PMI company can step in and compensate the lender for a portion of or all of the losses caused by default. Since the PMI company is ultimately covering losses, they will call the shots and may delay or even kill the short sale as they investigate the delinquent homeowner's financial position. It's not uncommon for the PMI company to ask the homeowner to agree to pay back some of the losses by signing a promissory note. You can see how a short sale transaction could die a sudden death if this were to happen. On the other hand, the lender will often allow the home to go through to foreclosure, since the PMI company will compensate them nonetheless. 15. Drama with inferior lien holders. First of all, what's a lien holder? That's a creditor who has an interest in the property. Many homes, particularly between 2001 and 2007, were purchased with first and second mortgages. So there's usually a second lien holder whose loan is secured by the property the seller is trying to short sell. The short sale cannot be completed, which means you can't buy that home without the lien holder being satisfied in some way. Why are they called inferior liens? Because their financial stake in the home was recorded at a later date than that of the first lien holders. All this means what? Inferior lien holders will want some monetary compensation for releasing their lien. This may be as little as $500 or $1,000, but it's often much more. Short sales can fall apart because the second lien holder won't cooperate with the parties to the transaction, and sometimes the buyer has to bring money to closing to pay the second lien holder themselves. This might happen because the first lien holder disallows the seller, owner, from paying anyone else. Bank-owned homes, or REOs. What is a bank-owned home? Also known as an REO, it's a home that was taken back by a lender or any of the major entities that buy and sell loans, such as Fannie Mae or Freddie Mac. Where and how was it taken back? At the auction, known in some states as the trustee sale, and in other states as the sheriff's sale. No one else bought the home, and so it reverted back to the bank, who had a financial interest in the property. Even homes owned by government agencies such as HUD or the Department of VA can be considered to be bank-owned. In all these cases, the home is owned and being sold by an institution, not an individual. In a short sale, the lender has an interest in the property, but the title still rests with the individual homeowner who borrowed the money. With an REO, however, the title has already passed to the lender. The home was legally and forcefully taken back for non-payment. The previous homeowner has no involvement. The bank controls the entire sale. Important considerations when buying REOs. 1. Many REOs will sell at or even above the asking price because they're often listed low to create a price bidding frenzy and then sold to the highest bidder, much like the eBay concept. Homes that have been on the market a long time, say 6 months or more, due to price or condition of the home, usually end up being the best deals as the bank decides to drop the price. 2. Banks have a duty to their investors to minimize their losses, but at the same time they must quickly dispose of non-performing assets. So there's a delicate balance, and this is why many buyers buy an REO at market price and others get great deals below market value. That bank's present load of inventory can dictate how easily they're willing to unload any given home. 3. Counteroffers and REOs go hand in hand. Banks counteroffer your offer almost 95% of the time. Some say this is the bank's way of letting investors know they're looking to get top dollar for the home. So be prepared to counter the bank's counter. It's just how the game is played. And once you do, don't expect an immediate response. Banks have special departments set up to handle negotiations, and there's usually a final decision-making person or committee if the property is being sold below a certain price. The counteroffer may even say it's subject to corporate approval, so expect to wait 4 to 7 days or so for the final addendums to come through. Remember, even though your real estate agent may work weekends, banks usually send their employees home 5 p.m. Friday evening. 4. Consider the condition of the home and possible repairs. Be prepared to buy the property as is or make a strong offer to get your repairs made. Banks will always push to sell the property as is to avoid coming out of pocket with additional money. Section 1 termite clearance is typically still covered by the bank, but you will have to work hard to have additional items covered. Working with a solid real estate agent can help your negotiations. Some homeowners who lose their property to a lender frequently damage the property, so be prepared to do renovations and repairs. Hire a licensed home inspector to give you a written estimate of the cost to repair the property. Budget that number into your purchase price. Repair costs can be used later in the negotiation with the bank to reduce the asking price. 5. Banks will take into consideration how your financing is structured. Unfortunately, government financing such as VA, FHA, and USDA are considered more cumbersome for banks to deal with than conventional financing or cash offers. So if you are buying with cash or conventional financing, you probably stand a better chance of getting your offer accepted. If you are coming in with FHA or VA financing and you know you're competing with conventional financing, you may want to tip things in your favor by offering maximum price or putting down a larger earnest deposit to strengthen your position. Not only is the bank looking at the type of financing you are using, but they are more inclined to accept an offer with the least amount of contingencies. Contingencies are pit stops during the loan and home buying process during which you, the buyer, must decide to cancel or move forward. Contingencies include inspections and due diligence period, appraisal, mortgage financing, and even the time period for removal of all contingencies. If you are confident about any or all of these, you may consider going lean on contingencies to maximize your chances of getting your offer accepted. 6. Special financing. Make sure you are aware of special financing options for certain bank-owned homes. For example, Fannie Mae-owned homes can be bought with a HomePath conventional loan where you can borrow up to 97% with 3% down without an appraisal and without mortgage insurance. Your real estate agent can locate Fannie Mae-owned homes in your state. Standard sales. Standard sales involve homes being sold by an individual owner or entities other than banks. Sellers in standard sales may also be investors who acquired the property, rehabbed it, and are reselling it for a profit. These are also known as flips because the property is literally being flipped for profit. If you are getting financing, especially FHA or VA, you should check for overlays in your lender's guidelines regarding flips. For example, FHA imposes certain restrictions if the property is being resold for profit before the seller has owned the home for 90 days. Standard sales allow that personal touch that is often absent when dealing with a faceless bank or REO company, because individuals much like you may be the ones selling. They may be more flexible, understanding, and more lenient if you have special requests pertaining to repairs, concessions, or extensions to close of escrow if the process is delayed. Standard sales also give you, the buyer, a clearer path to convey to the seller your strong points. A good real estate agent may turn in a cover letter outlining your strengths so that the seller can grasp why you'd be the best buyer to sell to. Thank you for watching, and be sure to contact the featured real estate professional who provided you with this valuable video tutorial.